$4 trillion in commercial real estate debt is coming due by 2028, folks. And if you own a home in America right now, you need to understand exactly what's about to happen underneath the numbers you're seeing on the evening news. Mark Zandi, the chief economist at Moody's Analytics, just put the odds of a U.S. recession in the next 12 months at 48%. He called that number, quote, uncomfortably high, unquote. And that was before the private credit numbers we're about to walk you through even hit the tape. For the next 12 minutes, hold on to this. There is a warning right now on the record from names Wall Street cannot dismiss that the next housing crisis could make 2008 look small. But it will not look the way you think it will. It's not hiding where you were told to look last time. Let me show you 3 things they're not telling you. Number 1, we're going to show you the one number that proves this isn't 2007, but makes what's coming worse. Number 2, we're going to show you the group of firms that has been a net seller of American homes for 6 straight quarters while telling the public everything is fine. And number 3, we're going to show you the reason the 2025 Federal Reserve Bank stress tests were designed to miss the exact risk that just doubled in size. Stick with us, because if you own a home, if you're trying to buy one, or if you have a single dollar in a regional bank, you can't afford to get this wrong. Here's the foundation. According to the Mortgage Bankers Association's Commercial Multifamily Mortgage Debt Outstanding Report released March 26, 2026, there is $4.99 trillion in commercial and multifamily real estate debt sitting on American balance sheets right now. And per S&P Global's loan level maturity model, more than $4 trillion of that debt has to be refinanced, extended, or resolved between now and 2028, at interest rates roughly double what most of these loans were written at. That is your $4 trillion warning. It's not hype. It's a primary source figure from the biggest mortgage industry trade group in the country, and it's roughly the size of the entire subprime mortgage market at its 2007 peak. But that is just the anchor. The real story, everyone, is where that risk is about to land. Now, before I go further, I have to give you the honest half of this, because if I don't, everything else sounds like fear-mongering, and this channel does not do fear-mongering. American households are not 2007. According to Cotality, formerly CoreLogic, U.S. homeowners hold a record $17.1 trillion in equity as of the third quarter of 2025. Only 2.2% of mortgaged homes are in negative equity right now. At the peak of the last crisis, that number was 26%. Overall mortgage delinquency, per the Mortgage Bankers Association National Delinquency Survey, sits at 4.26%, nowhere near the 10% peak from 2010. Conventional loan delinquency is near a record low of 2.89%. And underwriting today is nothing like 2005. The no-doc stated income teaser rate loans that filled the pipeline in 2006 are effectively gone. But here's what's interesting. 2 things are actually worse than 2007. Investor share of single-family purchases has climbed to somewhere between 29 and 34% in 2025, per Cotality and batch data tracking, versus roughly 18% at the 2025 peak. And per Bank of America Institute data, new home inventory hit 9.8 months of supply in June of 2025, the highest reading since 2007. So if you're hearing me say worse than 2008 and thinking, come on, my neighbor isn't underwater or an Alt-A adjustable rate mortgage, you're right. That's not where the risk is anymore. The risk migrated. And that migration is what Wall Street won't say. Here's what happened. In 2008, the rot was in your neighbor's mortgage. Today, the rot is in 3 places nobody is putting on the evening news. First, commercial real estate and the regional banks and private credit funds that hold it. Second, the FHA loan segment, where the lower income buyer got hit hardest and the headlines are not looking. Third, the bills you pay to keep your house that don't show up in a single home price index: insurance, property taxes, condo assessments. Let me start with FHA. According to the Mortgage Bankers Association's National Delinquency Survey released February 12, 2026, the FHA mortgage delinquency rate hit 11.52% in the fourth quarter of 2025. Excluding COVID, that is the highest FHA delinquency rate since 2012. Half of all seriously delinquent mortgages in America right now are FHA loans, even though FHA is only about 11% of active mortgages. That is a concentrated pipeline of distress in the exact segment that can least afford it. And it's not showing up in the aggregate delinquency numbers because conventional loans are masking it. Here's the first thing I promised I'd show you. That number, 11.52% FHA delinquency, is the metric that proves this isn't 2007. Because in 2007, everyone was over-leveraged across the board. Today, the pain is surgical. It is concentrated in the borrowers with the thinnest cushion, in the metros that got most overheated, in the property types nobody wanted to talk about. And that surgical concentration is what makes it worse. Because when it breaks fast in specific places. And the people holding those loans are not diversified out of them. Let that sink in for a second. Half of all seriously delinquent mortgages in this country concentrated in 11% of the market. Real quick, if this market intel is helping you make better decisions, hit that notification bell. We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. Now, commercial real estate. This is the $4 trillion warning, and this is where Wall Street chooses its words very carefully. According to the Federal Reserve's April 2025 Financial Stability Report, bank credit commitments to non-bank financial institutions reached $2.3 trillion by the end of 2024. Per Risk.net's analysis of federal filings, aggregate U.S. bank CRE exposure sits at 369% of Tier 1 Capital Plus allowances as of mid-2025. And community and regional banks are roughly 5 times more exposed to commercial real estate than the largest banks. 44% of their balance sheets versus 13%. Now, read the specific 10K filings on SEC Edgar, everyone. Westbanco, 300.3% of Tier 1 capital in commercial real estate. Western New England Bancorp, 396.8% of risk-based capital. Atlantic Union, 276.9%. Byline Bancorp, 271.3%. Flagstar, the bank formerly known as New York Community Bancorp, flagged by Wharton researchers as an outlier above 500%. These aren't regional banks in trouble tomorrow. These are regional banks with concentration ratios that give them almost no room to absorb the maturity wall that is about to hit them. Zandy's Moody's Analytics team maintains a quarterly model that flags dozens of major U.S. housing markets as overvalued relative to local incomes, and pandemic-era boomtowns like Boise, Charlotte, and Austin have been at the top of that list for years. Moody's projects that in a recession, those overvalued markets could fall 15 to 20%. David Rosenberg, the strategist who called the 2007 housing bubble while he was chief economist at Merrill Lynch, wrote in August of 2025 that U.S. housing is now valued at approximately $48 trillion. That's more than twice its pre-financial crisis level. Twice. And Ivy Zellman, the analyst who called the top of the last housing cycle in 2005, has spent the last year saying that the stuck factor, the share of homeowners locked into sub-5% mortgages, is finally starting to break down, which means the supply side is about to shift too. But wait, it gets worse. Here is the second thing I promised. The 2025 Federal Reserve Bank stress tests, the annual exam that is supposed to tell you which banks can survive a crisis, were, per reporting on the results released June 27, 2025, less rigorous than the 2024 tests. Specifically, they excluded rigorous measures of private equity and private credit exposure, which is exactly the exposure that just doubled. Per the Financial Stability Board's May 6, 2026 report on private credit vulnerabilities, the private credit market has grown to an estimated $1.5 to $2 trillion in assets. And the FSB explicitly warned that private credit is, quote, less transparent, less liquid, and less subject to reporting requirements than public markets, unquote. That is the exposure the stress test did not test. Think about that for a second. Now, the third thing I promised, the group of firms that has been a net seller of American homes for 6 straight quarters. Per Realtor.com's investor report and CNBC's reporting of batch data figures, mega investors, The funds buying 350 homes or more at a time fell to just 7.5% of investor purchases in 2025. Volume down about 70% from the 2021 peak. Institutional buyers have been net sellers for 6 consecutive quarters. The largest single-family landlords on Wall Street, the same firms that told retail investors and home buyers for years that housing was the safest asset class in America, are right now selling more houses than they buy. And they've been doing it for 18 months. Here's the kicker. That's Wall Street voting with its capital while telling everyone else the opposite. Now, the concrete math, because this is what hits your kitchen table. Per U.S. Census and Fred data, the median U.S. home in 2025 was $416,900. Median household income was $83,150. That's a price-to-income ratio of about 5. Historically, it sat at around 3.2 in the 90s. Per Morgan Stanley research published in 2026, a buyer financing a median-priced home today faces a monthly payment of roughly $2,000. That's about double what it cost 5 years ago. And that is just the mortgage. Then layer the carrying cost the headline numbers ignore. Per California Department of Insurance data, the California Fair Plan, the insurer of last resort, reached a record 668,600 policies by late 2025, up 44% from a year earlier. Residential exposure hit $603 billion as of June 2025, up 424% since September 2020. In Florida, per primary reporting on post-Surfside condo law, owners are facing special assessments of $10,000 to more than $100,000. The Cricket Club in North Miami levied assessments as high as $134,000 per unit in 2024. And as of January 1st, 2026, Florida can no longer waive reserve funding for buildings 3 stories and up. So who does this actually hit? Let me break it down by group. If you're a homeowner with a conventional mortgage, a low rate, and equity, you're not the person this crisis is coming for. Sit tight. Don't refinance out of a 3% rate to chase anything. If you're a homeowner with an FHA loan, a 2022 or 23 vintage purchase, or a Florida or coastal condo, your exposure is concentrated exactly where the stress is. Understand your assessment risk. Understand your insurance renewal timeline. Understand your loan type. If you're a buyer, the leverage in the Sunbelt has flipped to you. Austin down about 4%, Tampa down about 4.5%, Phoenix down about 2.5%, Miami approaching 12 months of supply. New home prices have fallen below existing home prices in many markets as builders discount. Patience is currency right now. If you're a seller, per S&P Totality Case-Shiller, national price growth in 2025 was 1.3%, the weakest full-year gain since 2011. Real returns turned negative. Price aggressively. Every month you wait in an overbuilt Sunbelt metro is potentially a lower price. And if you have a single dollar sitting in a regional bank, pull up its 10K on SEC Edgar and look at the CRE concentration line. That's not paranoid. That's what an informed depositor does in 2026. Here's the take we'll defend. This is not 2008. This is the migration of 2008. The next crisis will not look like your neighbor's mortgage. It'll look like a regional bank's balance sheet, a private credit fund's disclosure page, and an insurance renewal letter your parents cannot afford to open. That's why Wall Street won't say it out loud, because the people they represent are the people holding the exposure. Bookmark this video, come back in 6 months, and check every single number we just gave you. That's how confident we are in this data. Subscribe and hit the notification bell so the next video lands in your feed the moment it drops, and watch this one next. We'll see you next time.